right, guys, I'll go ahead and get started. If for those of you coming in late or coming in, we will be sending this recording out. Really excited to be diving into the Elevate Passive Income Fund for you guys, a new vehicle for you guys to invest and invest alongside of us. This is a 506c, and so you do need to be an accredited investor in order to invest with us. So one of the most important parts of any deal, whether you're investing in a fund like this, a single deal, whether you're doing a single family home or a multi-million-dollar apartment, the fund manager team is one of the most important parts. And George and Eric have built a really great team here along the years. So we Elevate CIG. We own just over 5,500 doors currently. We've acquired over 6,943. We've exited 1,600 doors with an average internal rate of return of 42% on those exits. Currently about $600 million of assets under management. George and Eric, the founders of Elevate, starting from a construction background before pivoting into buying apartment complexes. Myself being a principal, we also have Mina on the call, one of the key account reps that we brought in along the years, including also Nick and Joel. And then on the property management side, Elevate REM, and we have Tessa and Mike. We brought on a separate CEO and COO to run that property management company, just because it's its own company, and you want to have someone that can really run that effectively. So this is a team that we've built over the past 6 years. Luke is with the J&T team that we'll be talking about here shortly. We also have a couple other key members on the team. So our goal is delivering strong risk-adjusted returns to our investors through any cycle of the market, for you to be able to invest in real estate without the hassles. So what you're going to learn today, how the passive income fund pays preferred returns of 14.5%, nearly double the S&P average. A great return that we haven't seen in other vehicles. We'll tell you how we're able to get that. How the investors who are already in the fund have begun getting monthly distributions from day one. Insight into our streamlined approach, where we handle acquisitions, renovations, what I talked about, property management, so you can enjoy the passive income without being the landlord and heavy lifting. Deep dive into some properties we own, our processes, and why we think we will outperform the market and outperform other operators. This is our 3 companies: Elevate Commercial Investment Group, which is our main acquisitions company; J&T Construction, which is a construction arm that George owns that got us started in real estate investing; and then the real estate management company that we started last year, where we brought on Mike and Tessa to really take control over the full picture of apartment investing. Property management is one of the biggest keys to success, and also one of the biggest keys to failure in rental property investing. So we brought that in-house last year, and as part of the initiative for this income fund, these will all be managed by us and our team here. So this does not happen overnight. This took 7 years of trial and error to really fine-tune this process of becoming vertically integrated and to having this awesome team that we now have, and I'm proud to be a part of. So we can spot good deals to place debt on. So that's a big part of our vertical integration here. So we'll be going into the investment overview, the Elevate Income Fund. So we've been talking about having a fund for years now. If you're following along with Elevate, we usually do syndications per property. So we've always had investors, one, who want more monthly cash flow, who want a fund, an evergreen fund that they can invest in multiple properties. We've actually borrowed from funds like this as well. We have preferred equity partners that come in to our deals or our past deals, where you'll have the senior debt right here, lowest risk, lowest reward. They're getting their 6%, their first position, and then you usually have preferred equity or mezzanine loan or some sort of credit, and then you have your common investors up here. The passive income fund is right there in the middle. That's where we're putting this into existing properties. So we're going to be lending the Elevate Income Fund into existing Elevate real estate assets, where you're coming in above common equity, usually, $5 to $20 million of common equity above that, and then below the senior debt there. We're going to cut this off at $10 million of equity. We could cut it off sooner at $5 million. The hold period, these are going into existing assets, so your hold period is shorter, 2 to 4 years. Your preferred rate of return is 14.5%, and half of that will be paid monthly cash flow distribution. So 7.25 cash flow distributions is great alone, but you'll also be accruing 7.25 at the same time. So your total preferred rate of 14.5%. Some investments you're looking at anywhere from 6 to 10% preferred rate of return. So if you're looking for a secure position, you're not as worried about upside, you're more worried about downside protection, this is an amazing vehicle to be investing. I'm investing personally as a limited partner in this deal. So is George Brew, our CEO. It's a great vehicle to diversify with. So a good point right down here is we don't get paid until you get paid. So this 14.5% is paid to you before we receive any sort of compensation. Here we can break it down into a $100,000 investment. What does that look like exactly to you? You can see here every month, if you were investing $100,000, you would be getting a $604 monthly distribution. And at the same time, that $604 would be accruing monthly. So every month that we have your money, you're also accruing this outside of your cash flow distributions. Right now, this is a 4-year model. We very well could exit in 3 years. But before you invest, I would be prepared to invest for the full 4 years. But very well could sell some of these assets in year 2 and year 3. Here is the breakdown for our target investor returns. You can see $100,000 invested is at 14.5% that I was going over, where half of that is current and half of it is accrued. We do have larger incentives, whether you're coming in as a fund, or you have more equity to displace. We have these larger incentives where 500,000 is getting that 16% and 1 million is getting the 18%. So pretty great returns considering your position in the capital stack and your layer of security in the deal. Here's an example of a deal that's being funded that we've invested into. We're actually coming in at 65% loan to cost here at the $4.1 million. So if you consider your placement in the capital stack as a priority, you're coming in before even the senior lender gets paid the remaining of their distribution. So really excited for our fund investors to be involved there. And we feel really good about this deal with this $4.1 million cash infusion that will still be getting this existing equity of $13.5 million back. So we'll be talking about more of that at the later this presentation, but not only do we want to be, we're not just funding deals just to place get this, higher cash flow, higher percentage, but we want to make sure that the deal makes sense to pay out the existing equity and existing debt. So we feel extremely good about that position at 65%. If our underwriting is proving that the full 100% will be paid, then we're feeling good about that extra at the 64% there. Yeah, I talked about a few different great incentives on why we like this opportunity. One is the monthly cash flow. When a lot of deals right now aren't distributing cash, some deals are even requiring extra cash. You have people that were looking for cash out refinances right now, where cash in refinances are not uncommon. To be able to get cash flow day one is super great. You're beating high yield savings account, where similar money market accounts are holding that 4.5 to 6% returns. Lower in the capital stack, higher security to you as an investor, and hedging against inflation. So a lot of people are waiting for the right time to buy, waiting for distressed opportunity or timing the market. I think you can get into trouble when you're trying to time the market. And right now you're able to put your money to work instead of just hitting it in that high yield interest savings account where you're actually losing money towards inflation. So investment fund criteria, we talked a little bit about this. Experienced deal sponsors will be the main sponsor on any deal that this is placed into. Growth markets, we're only looking at business-friendly, landlord-friendly areas, and high growth population. Clear path forward for the business plans that I spoke about there on the initial breakdown, and then risk mitigation. So choosing the right sponsor, we've learned this the hard way. We've partnered with people where things go right, they're there, but when things go wrong, which they inevitably do in real estate, they disappear or nowhere to be found. So in the beginning of 7 years ago, we started as more of a minority partner, or not maybe the lead sponsor, but after years of experience, we've taken on more of a lead partner role. And anything that we're doing moving forward, we have to be the lead, and we have to have partners that have good track record, that are boots on the ground to the project, that have experience in the asset class that we're investing in. We've seen partners that have great experience in A class, but when you put them on a C class, it's a whole different ballgame. It's a whole different animal. That's great that you have the experience in A class, but that doesn't necessarily translate over to C class. Same thing with A class investing. If you're investing in C class, that doesn't necessarily translate over to A class experience. So you want to make sure we're having partners, and any key partners that have experience in the same asset class, in the same market. Successful exits are huge. You saw on the beginning page of our exits that we've had. Background checks. Our institutional investors that are investing with Elevate, they do the same thing with us. This is something that we've learned investing with high level institutional type investors when they're investing with us. So this is the same process that we're implementing with background checks, net worth and liquidity checks, personal guarantees on capital placed, and credit history. These are all important vetting processes to do, whether you're investing with Elevate or you're investing somewhere else in another deal. This is a super important part of the process. Here is our market focus that we've had success over the years. We are not tied to these markets currently. I would say we're somewhat market agnostic. We're not buying on the West Coast. We're not buying in the Northeast. Sorry, Mina, that's where Mina lives, up here in Boston. I'm actually here in Northwest Arkansas, and George and Eric are in Dallas. We've had success, Texas, Arkansas, Oklahoma, Right now, we're seeing some good flow of deals in Kansas City. South Dakota is a great market we own in. Jacksonville, Florida, Columbia, South Carolina. We did have a deal in Augusta, Georgia. We no longer own in Georgia, but we've done great. We doubled an investment in Georgia. That was a big value add plan there. We would buy again in Georgia. The Cincinnati tri-state area is another good pocket. So these are probably our core markets, besides Dallas and Texas, Northwest Arkansas, and Kansas City. So one thing, or a couple of things, these things all have in common, these markets that we're looking at, is being business friendly and landlord friendly. That goes a long way when economies see recessions, when economies are growing. You want to make sure that the market supports job growth and supports it no matter what kind of economy we are in. We like multifamily because it is recession resistant. Nothing is recession proof, but people are always going to need a place to live. But within that, we do like to be very specific about our markets, and especially when we're placing this fund. So strong school ratings are great. It depends on the asset type there. Oh, I got kicked. Hey guys, okay, we're back here. Technical difficulty there. My computer. Okay, back in action. All right, so those are the markets that we're looking at. Once you get past the market, one of the most important things as well is the business plan. So what's our plan to come into a property and improve it? How are we going to come in and achieve this 14.5% to 18% return to our income fund? And then above that, how is the income going to be treated in the property? So a big part of that is the business plan and how you're going to implement the business plan. So not just looking at numbers on a paper. That's stress testing the deal. What happens if cap rates go up? What happens if interest rates continue to rise? That's all part of the underwriting. So most of these deals that we're looking at are going to be value add plans where we're coming in, where maybe we see that they've where the interiors, 50% of the interiors have been renovated and they're achieving a $200 rent increase. So we're looking at that, where if they can't refinance right now because of the interest rates, then we'll come in with this income fund and they'll be able to get an extra, $1 to $4 million in that example, where they can go in and finish the rest of the renovations and achieve that higher income where they're adding value to their property. And then in a point of 2 to 4 years, they're able to cash out or sell the property. In most of these situations, the property is going to be sold. So that's part of the business plan there. Getting to a point where you're getting a cash out or a cash in refinance, maybe helping that situation where you're able to do a refinance. So this is all based on conservative underwriting. Like I mentioned, we're stress testing the deal. What happens if not only cap rates and interest rates go up? What happens if people move out? Or what happens if you achieve certain economic vacancy? What happens if there's something in the market that more supply comes into the market? All different factors that we're looking at. You want to make sure, two of the biggest things right now is insurance and taxes. Especially in Texas, you want to make sure that you're underwriting for insurance increases, and anything that we're doing, we're not just doing rules of thumbs. You can get in trouble when you're looking at rules of thumb. So we're hiring tax consultants. We're actually consulting actual insurance agents to get actual quotes. It's one thing to say, oh, insurance is going to be $800 a door. It's another thing to go out there and get actual quotes and see what their projections are. We're talking to the property management companies it's one huge benefit that we have is we have our own property management company. But same thing with our construction company. Just because we have our own property management company and our own construction company doesn't mean we're just relying on those numbers. Same thing with anything, you want to get at least 3 quotes. So we're going out and getting other property management opinions. We're getting other construction opinions on any sort of quote. Also, as another part of the risk mitigation here, we're doing making sure that some of these sponsors are doing personal guarantees and bad boy carve outs, making sure they can't just run off with the money there. Full control over the property, execution of the business plan, payment default situation. So these are all things that these risk mitigation factors you're seeing on the screen right here. This is all what our lenders require from us and what our institutional investors require from us. So definitely something that we're implementing here too. So, like I mentioned, a clear path to exit and refinance in the next 2 to 4 years. So that's the investment vehicle timeline here. And that's what I would be ready to deploy. You know, this is a more attractive timeline where most of our investors are used to that 5 to 7 year period where we are able to exit in 2 to 4 years because we're deploying on already existing deals. This isn't going for new acquisitions where you have acquisition risk, different entitlement issues coming up. So we really like that shorter time frame for our investors on this vehicle. So here's some frequently asked questions, and if you guys had more questions throughout the presentation, you guys feel to put those on the slide here. When do I start receiving cash flow distributions? This is monthly after the first month after funding. So if you were to invest today or tomorrow, then you would get your first distribution June 15th. If the deal sells or gets refinanced in year 2 or 3, we would have the discretion to reinvest those funds. This is our first fund, so we're incentivized to give you guys back your money as soon as possible. So we can roll out fund 2, fund 3, fund 4. This is not our first real estate deal, but it is our first fund. So we want to establish this good track record on this fund so we can continue rolling those out. If the borrower does not pay, we will be able to go personally guarantees. Where our goal is not to take over these assets or to, be some sort of predatory lender. Our goal is to work hand in hand with it, but we would have the option to do so. Elevate is paid the difference in between the spread. In most cases, that's anywhere. So if we're lending to a deal at 18% and we're giving the deal 14.5%, a lot of times we are paying that full investment amount. We have a lot of large investors investing that $1 million, so we are not getting any money on the front end. All your returns are net of any fees and net of any payouts there. How safe is this investment? No investment is guaranteed, but as shown on page 6, right here, we are in a very good position in the real estate deal. So we feel very good about this. We're all personally investing in this vehicle as well. So it takes a priority over any equity in the deal. Which of the team, I'll go ahead and start answering some questions. And then I will take you guys through the portal here. So which of the team members shown on the last slide will be primarily running the MFCI fund? That'll be George, Eric, and myself. We have experience, and George and Eric have a lot of experience in hard money lending. And then all 3 of us have experience in lending our own capital to deals. We're all investing, we're active investors, but we're also passive investors as well. So we're constantly lending our money. If the interest rates were lower, would you take commercial bank loan versus fund cash in with this fund? So usually these the deals that we're investing in, they'll have already the commercial bank loan that's anywhere from 4 to 9%, where we're coming in with the 14.5%. So this is sitting above that senior debt, and then equity is above our investment. So those are great questions, though. I'll take it. So if you guys want to learn more and go deep in depth, Mina is happy to schedule a call with you guys. If you want to put your chat in there, this goes to all of us. If you email info@elevatecig.com, Mina or myself will be able to jump on that right away. You can also book a call. I will take you guys to our investor portal to show you what that looks like. So that's going to be elevate.invportal.com. You get that pulled up. Mina, do you want to put your Calendly link in the chat?
Yeah, one sec.
Okay, so this is what our investor portal looks like. This is where we'll send our distributions to. This is where you'll get your tax documents. This is where you can find all your investments. You'll put your name, first name, last name, email, phone number, state you're from. You can put whatever you want here, how much you're looking to invest. If you're an accredited investor, so this is a 506c, accredited only. And that's annual income of 200,000 in the most 2 years, or joint income of 300,000, or net worth of 1 million, either or. You can put how you heard about us, and you put it. I already have an investor account. Like I told you guys, I'm investing in all our, you can see that these are all the deals that I'm invested in personally. Here you'll be able to see the real estate income fund, where our minimum investment is $50,000. This is where you'll be able to see the subscription document, your operating agreement, your PPM. These are all able to review. You'll actually be, you can invest as, here are the different investments you can do. IRA, we have a lot of people that are investing through their self-directed IRA accounts, which is a great vehicle, especially for the income fund, where you're already getting the tax benefits through the IRA. Individual, that's how I used to invest. I now invest under my trust as a limited partner. You can do joint registration or LLC. Then you'll want to make sure you put in your correct distribution method. This is not what you're going to be sending your funds from. This is where you're going to be receiving your funds. So you put that in here. So I'll go, I have 2 profiles set up. A is for 100,000, B 500,000, C is 1 million. So for this example, I will just put $100,000. And then from here, you'll be able to e-sign. You'll want to review these documents. This goes into all, way more in depth on what we covered today on how you're structured in here. It'll talk about how you get paid first before us. Exactly what I talked about here. I'll skip this for now. It'll take a while to go through those. And then you can actually ACH it. ACH can be hit or miss. It takes 5 to 7 days. Me personally, I wire. You can do either one. And this is, you take a screenshot of this and you take that to your bank, and that the wire is a lot faster, but ACH is another way you can do it directly from that bank account. Can you address the risk and how is the LP money security protected? Yeah, so no investment is guaranteed. No investment is risk-free. If someone is telling you that, I would be pretty cautious of anything else they're saying. But we think that we have really found the perfect way to mitigate your risk and maximize your security solely in that capital placement. If you looked at nothing else on the deal besides having a really good sponsor ourselves, being main sponsor on any of these deals that we're placing our funds in, we have control of this total conglomerate of the fund. The markets that we talked about that we're investing in, the asset types that we're investing in, multifamily, those are all great. But what's even better is its position in the capital stack, where you have, the deal would have to basically be sold at a complete loss for you to not get your money back. So we feel really good, that you looked at that example where we're investing up to 65% on the loan to value, where me personally, I'm also investing in deals where I'm going up to 100%, where I have greater risk. I might have more reward on those deals where I'm not getting it, where I could be getting more upside, but at the same time, I have greater risk of losing my capital. So this deal, you're not capturing upside above your preferred investment, depending on how much you're investing. It could be 14.5 to 18%. You're giving up that upside by getting more protection on your security of the deal. So you're giving up the upside above 14.5 to 18%, but you're getting a much better security. Since the first lien bank or agency must approve the preferred equity for its project, have any of your previous pref equity deals have been done on an agency loan, bank loan, commercial? Yeah, we've done preferred equity on agency debt and bank loans. So I like agency the best. Usually you get the best terms for those kind of deals. But any deal that we're doing, if I'm not willing to sign on the loan, then I don't want to do it. It has to be a good enough deal for me to sign personally on the loan. So I'm putting up not only my investment, but my full net worth, liquidity, all on the table. And that's exactly what we're doing for all of these deals, is we're personally signing on the loan. So, you as an investor are not signing on any loan, so you have no sort of recourse where we would in that case. But preferred equity, yes, we have done that on previous projects. And that is one of the ways that we've formulated and kind of came up with finding what the market was, what's a competitive rate that we can offer and still achieve on these multifamily deals. And that's where we were able to get this 14.5%, where we're paying that half current and half accrual, which is better than anything we've seen in the market as far as a preferred equity investment. Mina's putting his Calendly link here in the chat. If you guys are getting the recording, Mina will, after this call, he'll be sending you the full recording as well as a link. In that link, he will be sending his Calendly invite. This is going out to 100 other registrants. So if you guys are interested, I definitely encourage you to take action. I don't think our Fund 2 and Fund 3 will be as high of a return as this. This is our first one. We really wanted to get a lot of interest, a lot of momentum with it. So we came out with a higher return. So definitely, if you're interested in this kind of investing, monthly cash flow, then definitely encourage you to take action. Do we have any non-accredited options? Yes, if you are a non-accredited investor and you have talked to Mina, he can absolutely help you out as far as placing your capital. So definitely reach out to him. He's Mina at elevatecig.com or this email right here. But we can help you out. Can you share a project that went sideways and how you mitigated that risk? So I get the deal that I mentioned in Augusta, Georgia. Actually, there was a huge delay in getting the construction started. But we were able to send George and his team to take over the construction, and we were able to get, it was like a 2.1 equity multiple in just 18 months that we had that. We have a deal in Houston, C-class deal. The residents were on rent relief, and after COVID, rent relief went away. So we had a bunch of residents who were just not paying. It was floating rate debt as well. So you had two double whammies there, and we had to come up with the extra capital ourselves to put back into the property to get it to a place of a better position. So both those learning curves, the big thing there too is having the right partners that can take action quickly. Real estate is a slow moving industry. It's a slow moving industry, and it rewards the people that act quickly. It moves fast and it moves slow at the same time, if that makes sense. So we like to move fast. You'll see if you send us an email or anything like that, we'll get on it right away. But having the right partners is key. Being in the right market is key. Doing your due diligence on the property is super important. Diving in, making sure if you have residents who are C-class, making sure that they're not just in the door, making sure that they're actually paying. We've had a lot of experience with C-class, so making sure that doing audits on all residents who are actually funds received, that's something that we've seen in the C-class industry that is something we're watching very closely. Mina's email again is mina@elevatecig.com. All right. Looks like there's another one. Can I invest with my 401k without accruing penalty? Yes. Quest Trust is who we've been using, right, Mina? That's who, is it Quest?
Yeah, I answered that first. You see, if you email me, we can sort that out for you and get you the resources that you need.
Yeah, it's a great vehicle. I invest with cash, but we have a lot of investors that invest with 401k. All right, yeah, if you guys are ready, you can go to the investor portal. If you want a little bit more information, dive in deeper. You can book a call with Mina, or you can shoot him an email, or you can do that through info@elevatecig.com or mina@elevatecig.com. All right, well, appreciate everyone coming, and for those who ask questions, excited for you guys to take advantage of this fund with us. Thank you.